Have you ever wondered how a sports team can show a $4 million loss on their taxes when in fact they made $2 million? Well, the answer to that is the roster depreciation allowance. It started in 1934 when the Pittsburgh Athletic Company took a deduction on their taxes for the cost of the player contracts. The IRS disallowed the deduction and it went to court. It ended up being a landmark tax case, and it started the amortization allowance for player contracts. In 1946, Bill Vick bought the Cleveland Indians, and using the 1934 case against the IRS, he allocated a substantial portion of his purchase price to the player contracts and started deducting them. The reason he decided to do this is he needed a carry forward loss. The individual tax rate at the highest level was 91% that year. So he used his influence he had with some friends in the IRS, and he got them to recommend a change to the code, which eventually became IRC 167, and that made all assets, tangible or intangible, to be able to be depreciable as long as it had a usable life and was used in a trade or business. In 1970, Bud Selig purchased the Milwaukee Brewers, and he allocated his total purchase price to the contracts, but this time the IRS disallowed it, so he took it to tax court. After a 3-year battle, he ended up winning, although they didn't allow him to allocate as much as he had on his taxes. He still won the case, and it caused the IRS to change their whole code, and they instituted the Tax Reform Act of 1976. Under that, sports franchises became the only industry that was restricted in how they allocated their assets to determine the worth. It also started a new rule, which was IRC 1056D, which exempted the sports franchises from allocating 100% of the asset, and it developed what they called the 55 rule. So they could take 50% of the purchase cost of the franchise and apply it to an intangible asset for player contracts, and over the 5-year period they could amortize it. The American Jobs Creation Act of 2004 took everything away, and it really made it more simple. It started the IRC 197, which is basically a 115 rule. It replaced the RDA with goodwill, so now they don't have to allocate it to the cost of player contracts and try to do a lot of difficult math. They just apply everything to goodwill that they didn't buy. Say, like if they bought a stadium, they would apply that as regular asset, and everything else would go to goodwill. And now they can amortize 100% of it over a 15-year period. So basically what this means is that they get a double expense, because they get the cost that they paid for the franchise applied to the players and amortized over the 15 years, plus whatever they pay the players every year. So they get a dual expense for that. And that's why a sports franchise can show a $4 million loss, even though they made $2 or $3 million. And if they're listed as an S corp or a partnership, they can always take the loss down to their personal income, which is the whole reason this thing started in the very beginning in 1934. Well, I'd like to thank everybody for watching my video. It was really interesting for me to learn about this, and I hope you did too and got some enjoyment out of it.